Hello, hello. Hey, everyone. How are you guys doing?
Good. I'll be the first to respond, I guess.
Let's give a couple of minutes for the rest of the gang to join, and we'll get started.
Good morning, Vivek. Good to see you again. It's Ravi.
How are you?
Good. How's everything?
Good.
That's awesome. That's awesome.
Can't be better, right? We are at all-time highs.
That's true. So what's today? Today in your book?
Um, Two things. One, of course, I'm gonna cover the stuff from the backlog, which is last week we couldn't cover because we had a shorter session, which is on the buyback checklist. And this was a FOMC week, so we're gonna cover that. Plus, I came across a nice study around being an active manager, right? If we are an active, or if you're a fund manager or financial, a manager, whether God's foresight, how the life would have been, right? Even God could get fired as a financial advisor. So that's why I always say investing is very simple, but it is not easy. So came across a study which I found, I think, very interesting. Right? And here we are trying to predict what's going to happen and take swings on the market as if we know what's going to happen. So that study is very interesting, that assuming that you know what's going to happen in 5 years, how would it have worked out? Yeah, so that's I think two stuff. Of course, we're gonna talk about what's happening on the crypto market or equity market. Anything else you guys have in mind? CMS Nyanka, good morning, Nyanka. Hey, morning, Ravi. Niraj says he's doing good. Yes, I'm very well. Thank you, Niraj.
So when do we short a market, man?
Right, that's why it's so difficult to try to time the market or short the market, right? So, I mean, I've not been, and you guys know, right? I've been a little cautious. I've been cautious throughout this year. I mean, at the start of the year, of course, in April became bullish and did a lot of, but I've been a little cautious. But that doesn't mean I'm going to short the market or get out of the market. Just that I'm not adding too many deltas, going very long on my deltas right now. But so eventually that means market goes up. I could have made more money than what I've had. It's okay. Have had a good years, and I don't have to be really very greedy. I think I did tweet about it when was it yesterday, before, after the FOMC, where the markets are like all ripping higher. I'm like, I lost some deltas, but I gain on my portfolio, right? So you win some in the market and lose some in the market. That's very good position to lose deltas and gain on portfolio.
Hey, my Intel is up, finally.
Sorry, what's up?
My Intel is finally up. Right after holding forever, my Intel.
Intel, yes. Yeah, well, we'll talk about Intel. Intel got a breath of fresh air.
But I took profit and now I'm out.
All Nvidia.
Vivek.
Aditya, good morning, Aditya. David is saying there's $7.2 trillion money market fund. Yeah, so I mean, I remember once we started tracking, it was around, I think, $5 trillion or $6 trillion, and just keeps on piling. $7.2 trillion. Only one thing which I thought I have around that is, as a stock investor, we think that that's some money sitting on the sideline and will rush into the stock market once the rate drops. I don't know. Maybe these are the people who probably, instead of a money market, might rush into other safer instruments. then coming into the stock. So I'm not sure if the rate drop, all those who are sitting in the money market funds, they are sitting in money market funds because the yield is higher or because they are just looking for safer instruments, right? And I don't think anybody knows. If those are the investors who are looking for safer instruments, then maybe they'll go somewhere else, or maybe they'll be okay to have a lesser yield, but the more safety, right? That's
You might have mentioned this some time ago. I forgot. But what do you go to see where the money? I mean the big investments they're selling.
big investments who's selling me.
Right, like for example, I mean the big investment banks and all that. What do you go and see to say, hey, you know what, they're selling instead of buying?
I don't think I actually track that.
Okay.
I mean, I look at a 13F when 13F comes out, then I look at it. But on day-to-day basis or weekly basis, I don't pay much attention.
Vivek,
Yeah.
I don't understand. Well, number one, thank you for your intuition that you're just going to own Intel because there's something there. Because I kept my Intel. Unfortunately, I sold a bunch of it. But anyways, what I look at this is that is Nvidia is like all developing countries, they're giving away access to their technology, tech transfer, and then there's import substitution. How do you look at it?
Tech transfer, I mean, Nvidia giving its technology?
Well, I mean, they're buying into Intel, and I guess for access into the Intel market, into the U.S. market, they're don't you look? So I'm looking at this as tech transfer and import substitution.
No, I don't think it's that one. I mean, there is you on. Okay, we'll talk about Nvidia and Intel once we reach on the equity part.
Okay, thank you.
Our discussion. So yeah, let's talk about that. Sean says he's got in SoFi early. Congratulations. I think SoFi has been doing pretty good. I mean, I don't own SoFi, but SoFi again hit a. Is it a new all-time high or it's 52-week? I think maybe it's a new all-time high on SoFi. Right? So congrats. Let us have a question in MM.
Hi, my name's Linda. I have a question on the money market you were just talking about. So you said there's $2 trillion in money market. Do you know what the levels are before the levels of money market before the rates were lowered, or like maybe if there's a comparison to prior year levels to see what like the base and the norm money market is, so you have an idea?
So I think earlier I have seen that it was around $4 trillion, like before 2023. I remember discussing, or maybe it came up in some charts around 4 trillion. Now we're looking at what asset money market funds. This is September 18, 7.28 trillion. Right? So
Okay, so from 4 trillion to 7 trillion.
correct. But we also know that the market has also gone up higher since then, and maybe some people who have taken gains might have parked into money market fund. Who knows? Or maybe the money market fund is where the safe money is sitting in. But I think a lot of the investors or financial advisors or RIRs, they are still talking about the fact that you can't short the market, given the fact we have more than 7.25 trillion sitting in the sidelines. And that money is expected to move into stocks once, you no longer can get 4.5 or 5% in money market. So yeah, so I think this page shows us the total amount of money market. Retail has got almost 3 trillion. Sorry, this one, yeah, almost 3 trillion, and institutions 4.3 trillion. Ravi, why Oklo going up? So we will talk about that. There was a deal between US and UK. President went to UK and it signed some deals around nuclear energy. Not just Oklo. A lot of other nuclear stocks will be high. Aditya, you're bringing up a topic which I thought, should I talk about it or should I not talk about it? Because that's also a little bit, politically sensitive, and I want to steer away from any discussions around politics. Satish also brought up the same stuff. So if you look at some of these IT outsourcing companies, I think their stocks already got hammered in after hours or so. Either Accenture, where's Accenture's chart? Where can I see the after ACN? Oh, Google has changed its Google Finance stuff. But I did read somewhere that Accenture and like companies like Cognizant Technologies, yeah, so that's down like 5% in after hours, etc. So there are already, but we don't know, right? This will get contested in courts, etc. Even in a phase one or of his presidency, there was some exorbitant fee that were levied and that were contested in court. Or it might just be a negotiation technique for the tariff negotiations. Who knows? But yeah, that's one another big news, doing around the circles. All right, guess we have a quorum, so can get started. Let me see if I missed any other questions. Nope. All right, guys. Sean says going long term on MP. Input analysis on MP. MP is that MP Materials, right? That stock. Oh, let me. Yeah, I've not looked at this business. I mean, I know Chamath. Are we talking about the same thing? MP Materials. This is the one which has got contract from DoD for some rare earth. Is that the same company? I think so. Let me just make sure I got the right MP. Yes, MP Materials. I mean, it's a small company, smaller revenue right now. It's all based on, it's strategically important for US to have its own deposit, not just the deposit, but I think more important is the processing of rare earth minerals. It's not that China has the world's largest deposit, but China processes 90% of rare earth minerals. Processing of these rare earth minerals is not easy when given the fact the environmental concerns, etc., around it. And that is why we were very happy having this processing done in China and not done in US. But if we have to build our own strategically important industry in which rare earth mineral is, then yeah, these companies will see the tailwinds. I mean, and MP Material already, I think government took a stake in MP Material, if I recall correctly. And then I think there is also a contract from government I think Pentagon signed a deal to buy it. So they do have a customer. They do have a predictable revenue stream. The question, which as an investor we should always ask is, that's fine, but what are we paying for it? I've not looked at the business, but right now, I mean, it should be pretty expensive. Right? I'm long on WWR. I have no thoughts on, this is a pretty small company. I generally don't even look at it because no thoughts will work on this one. This could be just manipulated by a few traders. Apple has made multi-year $500 million commitment to MP Materials to purchase US-made goods. Yeah. I mean, and they also, these are the commitments, and who knows how the negotiation goes, and we can always change these commitments. Are not these are like a memorandum of understanding kind of a commitments, right? You can always change it. And if the MP material stock has already run up based on these commitments, the bigger question is what's the future growth if you're trying to get into it now. All right, so yeah, we have 15 minutes at the top of ours, so let's get started. Welcome everyone to our session number 293rd, where we meet every weekend, Saturday, 2.5 hours, talk about anything and everything related to investing as a retail DIY investor. So I'm not a financial advisor, or I'm not worked in a financial, or any investment or shops or brokerage, etc. firm. I spend most of my time and my life in my corporate life in technology industry, but I have been very keen interest in investing as on the sidelines just to manage my own portfolio, and almost last 3 years this is my full-time work. So today's topic is I'm gonna go through of course we'll look at a FOMC stuff and what came out of FOMC, start with at a macro level, then we'll look at an equity market, few of the news stories that caught my eye. You can bring up some of the things that you notice in the equity market. We'll also look at crypto side, what's the top news on the crypto, and then I'll take you through one study around why investing is so simple, but why it's not easy. Even if you had a perfect foresight like God, as a financial advisor or as a money manager, you could still get fired. So that's a very interesting study, and we'll end up with our session with that, and then we'll move into the breakout rooms where we can talk about different topics. So if you're interested as a day trader, swing trader, talk about that. Generally, the options room is the most crowded one. So we'll spend whatever 30 minutes, 1 hour, sometimes it goes for 2 hours until all the questions are answered. We just stick on in the breakout room. All right, so with that, let's start. Anything that we discuss here is only for education and entertainment. Please don't take it as a financial or investment advice. All right, so first one, something for a mind. This week I finished reading the book called Breakneck. Anyone else have heard about this, or reading, or in process, or have read it already? So this book came across my radar because Bill Gurley, who was the GP of Benchmark, the venerated VC firm in Valley, he was he recommended this book. So hold on, let me the share was wrong. Oh, okay, cool. So my apologies. Thank you, Bobby, for letting me know. So this is a fun of working with multi screens. Sometimes you forget which screen was I sharing. Now you see the document, right? Okay, cool. All right, so so this week I just finished reading this book called Breakneck, which basically talks about it's been written by Dan Wayne, who's of Chinese origin, came to Canada, now in US, and has spent considerable amount of time back in China very recently during the COVID. So he's put his perspective, pretty interesting one, right? So, and this was kind of recommended by Bill Gurley, and that came across my radar on Twitter. I thought, why not? So quickly we'll take you through, things that I found interesting in this book. One was between you, and this is mostly around comparison of US and China at a very higher level in terms of how the governments think about it and why China is strong in some cases And as US investors, and I've been guilty of the same thing, saying, US innovates, China duplicates, and EU regulates. I think there are a lot of things that we can learn from Chinese government. So that this book opened my eyes around what some of the great things that the Chinese government is also doing. So it's not that either US or China. There are things that we can learn from what's happening in China as well. Right? So few things that I liked about this book. One was clearly engineering versus lawyerly mindset that we have. That's a huge difference between how US thinks and how Chinese government thinks. So Chinese government is all about building biggest things, right? Great engineering projects. Biggest dam in the world, right? Three Gorges Dam. Now I think they're building another one, which is even bigger than the Three Gorges Dam. Longest bridge will be in China. The tallest bridges are in China, right? They can create buildings at certain record times. A lot of engineering mindset. Even if you look at the top echelons, Politburo members, most of them have come from engineering background. Difference between US and China, focus on invention or innovation versus a process knowledge. US is the leader when it comes to innovation, but then we don't know how to use that innovation and scale it and use it and create goods and products. Few of them we are, but to use it for every day-to-day life, right? So we are great and we reward basic inventions, and then China uses the same basic inventions and create massive at a massive scale. They're able to create industries, right? So many of the things on the EV, let's say solar cells, they're all invented in US, but now the China has the biggest solar cell manufacturing capacity in the world, right? So the quote that caught my eye was, US build the ladder on which basically China climbs. Physical versus virtual, right? Dan highlights that China's ability to build big infrastructure projects quickly, like high-speed rail, highways, urbanization, housing, etc. Whereas on the US side, we, even as an investor, right, we reward the companies that are capital light, right? Asset light companies are more focused on virtual economies, social media, e-commerce, those companies, right? And even if we go back to 2020, was it 2022, 2023, right? Chinese government, in fact, went against some of these virtual companies saying, hey, you're not doing, service to the nation by just focusing on building the best games of the social media companies, right? So we saw a lot of these tech, so-called what we call as a tech companies, their stock went, they were down a lot when the Chinese government started to tighten their noose on it. So of course, there is a lessons from both America and China. He also talks about some of the things that China did, which didn't work out well for them, in what they can learn from here. So, pretty interesting book to learn from, again, one of the biggest and the best economies of the East. So, if you get a hand on it, try reading about it. All right, so with that, let's get into our backlog from the last week, which was to talk about the buyback checklist, right? As an investor, we want our companies to grow for future. Any cash that they accumulate, they should be, it needs to be used properly. So buyback is one way in which the companies that you own can put their cash to use, right? So first of all, it means they should be generating cash, right? The business should be cash flow positive. Then you can decide what you can do with that cash flow. So what are the various options that as a CFO or as a business owner, your company has, right? If you have extra cash because you're profitable, you're generating decent cash, what can you do? You can invest in growing your business, right? Do an organic growth, maybe build a new plant, maybe hire more resources, whether it's human resources or robotic resources, right? grow your revenue, maybe move into a different product line. So basically organic growth, you can continue to grow your business. But sometimes it happens that I'm already like 50% of the market share, right? How much can I grow? There's not much growth left, or the incremental cost of growing is so high. Maybe rather than trying to grow, I look into merger and acquisition. Sometimes the company itself, they don't have a capability to grow because the market has changed. Right? So there are companies that you would see are pretty acquisitive in nature, right? Salesforce comes to my mind, Palo Alto Networks comes to my mind. They will always keep on acquiring companies. Well, Palo Alto started its journey as a firewall company, and once the world outside changed, CrowdStrikes of the world came and completely disrupted the whole model of cloud-based security. Palo Alto started doing acquisitions because maybe it's not in the DNA of the company to completely reinvent your stack of the product. You go and acquire companies, or you pay down the debt. During your growth cycle of the company's business cycle, you basically took on debt to grow your. Now, if you have extra cash, maybe you can pay down some of the debt. Or you can pay dividend because I got enough cash. I've gone through all these things. I don't think I can grow much faster because maybe I'm in a mature industry, right? And that industry itself isn't growing because we have had our years of growth earlier. Talk about, let's say, companies like mining, retail. The retail we grow at 2%, 4%, right? Not much growth. In that case, I would rather return the capital back to shareholders. I can pay them dividend, or the other way is to buy back the shares. So buyback shares have gained a lot more importance in US. If you look at outside the US market, capital returning is mostly through dividend, but it's pretty, I would say, US-based phenomena that US companies are actually do a lot more buybacks. And I love my companies, those who will do buyback rather than giving a dividend because it is more tax efficient to do buybacks. But I've also seen in recent times, a lot of companies are announcing buyback. Whereas, come on, guys, have you already exhausted your growth opportunities? Why do you buy back the shares? Can you not grow the business? Can you not use the cash that you have and invest and grow the business so that I get much better return than you just buying back the shares at the existing price? Or if you have exhausted all options of organic growth, how about buying another company, right? So these are the decisions that your company has to go through before they decide to return the capital back to shareholders. Yes, if you don't find any other way to grow the capital more efficiently, then you say, you know what, I've tried and tested everything. Here's a capital shareholder. You do what's best in your interest, right? So when you're looking at some companies trying to buy back, and this is specifically true because what I've seen on the US stock market is the moment company announces that, oh, we're going to buy back 100 million worth of shares or $1 billion worth of shares, the stock price jumps. Of course, because if the companies buy back the shares, the total number of shares get reduced, the total value, and then your earning per share will get increased. So the market tries to reprice the share based on the new EPS values, right? But I've seen some companies who are not that cash flow rich, who are still in the growth phase of their company, right? It's not that you are mature, that you have exhausted all options. You're still in a growth phase of your company announcing buybacks. So these are the buybacks which are like, what the heck are you doing? Right? So these are the buybacks sometimes companies will do. You need to find out, is it just to artificially boost the stock price? Before you go and see another company doing a buyback, announcing a buyback, and you assume, wow, company announcing buyback means they have got checked out all these items, right? They have a great cash flow positive company, they've already grown, etc. So it's a pretty stable business. So I should buy the shares of that company. No, that's what you should not do. You should run through the checklist to understand, first of all, what's the motive behind the buyback? Is it just to get the initial pop that we are seeing that the markets will do the moment you announce buyback? Is it to increase the EPS without improving profits? Right? Because once you buy back the shares, you exhaust those shares and you just increase the EPS. But maybe your profit is still the same. Company business is not growing, but your EPS is still growing. Or maybe it is improve the book value per share. Or this is what the most ridiculous thing which I see, right? Companies announce buyback. The first thing I go and see is how much shares did they issue to their employees, right? Through stock-based compensation. And many times you will see that, especially these younger companies, the growing companies, they will just do the buyback so that they can offset the dilution through the stock-based compensation. So the buyback is nothing accretive to us as a shareholder. So basically, they're increasing the number of shares by offering the stocks to their employees through stock-based compensation, and then they're doing a buyback. So net, it's like a zero-sum game. Right? And if you focus on certain companies, you would wonder, why the heck the total share count is not reducing even if they are doing buyback? Because they are also increasing the shares through providing stock-based compensation. The third is, are they trying to do a buyback because the CEO or the management is trying to reduce the number of shares, available shares, so that another company cannot do a hostile takeover? Maybe management doesn't want to sell off the company. Maybe they want to retain the control of the company, which may not be, sometimes it may not be in the best interest of you as an owner. But for a manager, this is where the classic agency versus the owner problem comes in. Sometimes you as a shareholder, you are the owner of the company. CEO is a manager who's managing the company on your behalf. Sometimes the interest of the owner versus the manager could diverge. Right? As a manager, I get paid a salary. If I've been taken over, I'll have to look for a new job. So I don't want anyone to take over my company. I'm going to buy back all the shares or majority of the shares that are available in the market. But is that really in your interest as an owner? Probably not. You could have gotten better value for our shares if another company takes it over. Right? So you got to look at, is it, any of these tricks? Why is the company doing a buyback? Is buyback the best use of capital? I think we already looked at some of the other use of capital, which was, have they evaluated alternative investments for better returns? Is a ROI from other uses of capital higher than the earnings yield? Right? Let's say your earnings yield is 4%, 5%, but you have a debt on your balance sheet which is like 7%. Why are you buying back your shares? Pay off the debt. Right? That will be a better and smarter thing to do, is to pay off the debt. Quick test: if a company can invest cash for greater than earnings yield, then it should not buy back the shares. It should rather invest that cash to make more than what's the current earnings yield is. Right? Financial impact. Will the EPS actually increase if the overall share count doesn't change? Because on one side they've increased the share, then the EPS doesn't matter. Is the company repurchasing share at a fair value or under price value? This is again one of many companies are guilty of buying back their shares at the worst prices when they should. Many companies will announce buyback when the shares are trading at an elevated, very overvalued prices. Why are you doing that? You should be buying back the shares when the market is completely, discarded your shares. When the market punishes your share, that's the time to buy back the share. Not when everyone is excited about your stock and it's already pushed up the stock price too high. Will buyback the shares increase the long-term shareholder value and not just short-term optics. Sometimes it's just to do the short-term optics. And I think there was one study, and I don't recall that right now, which is that majority of the companies actually buy back the shares. The majority of the companies actually destroy the value by buying back the shares, because they all buy back the shares when everyone is excited about the company, when the stock is trading at more than what it is actually worth, right? So they end up buying back the shares at pretty expensive prices. And finally, the red flags. Even if, let's say, the companies are buying back the shares, how are they buying back the shares? Are they raising debt? Or are they, are they weakening their cash reserves and then buy back the shares? Right? It's not that I would say it's a no-go for you. Sometimes if you can raise debt at a very low cost and inflate it away, and you have a predictable stream of revenue, sure, you can make use of that, right? A lot of companies have grown their businesses. I think John Malone, the serial kind of acquirer on the cable, he was like master of doing leveraged buyouts, right? But then they have a consistent revenue stream. For that kind of a business, I don't mind them taking a debt at when the debt is available cheaply to buy back shares, but not the others wherein they are paying through the equity, etc. Is the buyback timed before executive bonus or earning reports? Because many executives' bonuses or their salaries, etc., are tied to increasing their EPS. Right? You may want to buy back the shares just because you can increase the EPS and the management can get their bonuses. Or if the company have had no clear communication on capital allocation strategy and out of a blue, out of a blue moon, suddenly they will buy back their shares on one quarter. Then you should just worry about why the heck they're doing it. So some of the things, I saw it in an article around, I don't know if it was in Bloomberg or in Barron somewhere. And I thought maybe I'll come and share with you, because nowadays I see a lot of companies who shouldn't have any business in buying back the shares, but will come and make an announcement that they are buying back the shares. And then the share price will jump higher. I'm like, what the heck are we doing here? Right. So thought I'll share with you guys. Let me know your thoughts. I think there are a few comments on it. So let me go through that. They said it's a margin return in each additional dollar spent. Yeah, so they do all the calculations on NPV, etc., on marginal return on investment. And the whole idea is they should compare the other available opportunities before they decide that, yeah, I'm going to do a buyback. Neeraj says buybacks are financial engineering. Companies do it to fudge their P. Not always it's a financial engineering, right? I mean, there are very genuine cases for doing buyback. I mean, if you have additional cash that you can't find a best use of, yeah, maybe return it. And you can do both things. You can continue to grow your business organically or inorganically, plus still also return the capital to shareholders, maybe through dividends.
Ain't going anywhere. She don't grip, but she slides.
All right, so guys, if you're not have nothing, talk to someone else. Stay on mute, please.
Ain't going anywhere.
Okay. David says, I love buybacks as well. They don't issue. Yeah, exactly. Right. Splits has nothing to do with buybacks, etc. I mean, I'm okay with the stock splits. Not that I am looking forward for stock splits, but if company want to split the stock, it's fine. Right. That's just it's a same piece. They have not increased their equity capital or equity base, just that same pizza, now they created more slices out of it. So, but I've seen some companies, again, this is how the market is, right? If a company announced stock split, then you would see, for whatever reason, companies think that they can get a lot more shareholders interested in it, because someone with a smaller capital to invest in is now eligible to invest because your stock is no longer valued at $1,000. In an era wherever fractional shares available, I think that logic is out, can be thrown out of a window. But companies still use it. I've seen companies saying we are splitting the stock because we want to increase our shareholder base. I'm like, what? Stock splitting only helps the option traders. If you are just a stock investor, yeah, if you don't want to invest, let's say $2,500 in buying Mercado Libre shares, yeah, buy just 1/5 of a stock. You can buy fractional shares. You can only buy $500, right? You don't have to wait. But I think as a humans, we have a bias towards unit. We feel great if we can buy 1, 10, 100 shares of a company. And so if Mercado Libre, I hope they don't split it, but if they split their stock, 1:25, each stock becomes, let's say, $100. I might feel better by owning 5 shares at $100 each rather than owning 0.2 shares, even though it's the same investment, even though you own the same percent of the company. There's no difference in the stock split. But the stock will jump higher when company announced stock split, as if anything has changed in the business. ATHs can also be a symptom of the fact that the companies are being run by financial professionals versus accountants and builders, engineers. I don't think so. I mean, if they are using these engineering, they're using a reason which is other than the good reasons that we talk about, right? If that's the case, then yeah, they're just trying to artificially either boost the stock price, get a short pop, make it look better than what the right reason of buyback should be. There are smart financial engineers. Yeah, there are many. Question Rutwa asked, does that translate my MA, MasterCard, Visa, Apple exhausted ideas? No, I said, right, you can do both. You can do both because Apple generates so much of a cash, right? Where are they going to deploy? And in some cases, it is better to return the capital to shareholders. Otherwise, the managers who are not, I mean, it's like the manager could use the cash if it is still in the balance sheet to go and do some acquisition which they should not have done. It's like, a kid suddenly came across, a decent amount of money and they don't know what to do with it. Right? So it's a very tricky and a fine balance that the management team has to make. In terms of, we'll return the capital to shareholders, but we still have enough capital available to do any decent acquisitions, etc. The value of debt goes down to inflation. It doesn't make sense. I mean, I think we already talked about it. Usually buyback happens when the companies think that they are undervalued. That's what you would think. That usually buyback happens. But go and look into the history of buybacks. Why most of the buybacks result in a value destruction is because the manager buy back the shares when the shares is loved by the markets, which is completely opposite of what you should be doing. Which is you should be doing when the shares are undervalued. You should be doing when the markets is punishing the shares. But you won't be surprised to look at many of the buyback decisions are taken at the worst time.
So Vivek, the question is, where does this Tesla's Elon Musk buying the 1 billion stocks of Tesla stands?
So Elon Musk is buying in his personal capacity, right? He's not extinguishing the shares. So he's buying from the markets just like you and I buy from the market. We are not. So when the company buybacks those shares, they extinguish those shares. So if let's say overall there were 1 million shares outstanding and company buy back the shares, let's say 100,000, then you have only 900,000 shares outstanding. In case of Elon's case, it's still 1 million shares outstanding, just that the owners have changed. He bought it from the market.
Got it. Okay.
Yeah.
So shouldn't he have like approached the board to get the shares from inside? Because as a part of his compensation, right, he could have brokered the deal and he could have gotten this a much cheaper price than going outside and buying.
I
Maybe
mean,
he's
he
just
already
trying
has
to
a
inspire investors to buy more Tesla and kind of instill that confidence in them, possibly.
he already has a board. We talked about it, I think, 2 weeks ago, $1 trillion package from for Elon, which the board has already put forward for Elon. So he already has that. Right now, it may be based on that. Hey, if CEO is buying the shares, it means he's exuding confidence in the market. But again, sometimes this could be signal, and $1 billion means nothing for Elon anyway. It might just be a signal that we are reading into. Anyway, so let's move forward. Buyback is a very interesting topic, and it's a little bit a politically charged topic also, because a lot of lawmakers think the buyback is only going to enrich the rich people. And some people think, hey, you should be paying dividend and not buybacks. I'm on the favor that maybe rather do a buyback, but dividend is a cost you twice as a owner of the company. If I pay dividend, my company has to pay taxes. And then when I receive a dividend, because I'm an owner of the company, I receive a dividend, then I have to pay taxes, right? So, but there are reasons why companies will pay dividend, because, there are some investors who need consistent income coming in. So then you will invest in companies that pay dividend. Right. All right, coming back to now this week. So this was our last week's backlog. So happy to be done with the backlog. TradFi, looking at the macro side. So we had FOMC meeting this week. I would say this meeting was the most predictable and the most unpredictable meeting. Most predictable in the sense that we knew what's going to happen. We're going to get a rate cut, 25 basis point rate cut. If we look at those, the probabilities, market was pricing about 96% chance, right? So we knew what's going to happen, pretty predictable. The unpredictable stuff was who going to be participating in the FOMC meeting. There were court cases going against Lisa Cook. There were confirmation happening for Miran. So we really did not know how many governors will be participating in that until the last moment, right? So Lisa Cook also participated because I think the court put an injunction saying, oh, she can't be fired right now. And the Stephen Miran's, he was confirmed, and he was able to, I think a day before the FOMC meeting, and he was able to participate in it. So no surprises there. Fed delivered the first 25 basis point rate cut of 2025. We had a last rate cut of 50 basis points in 2024. That also happened in September. So now we crossed the one whole calendar year. Now we got 25 basis point rate cut. It was mostly a consensus decision, except, Stephen Miran, he was pushing for 50 basis points. But I think all the governors said, hey, let's do a mostly consensus decision so that the rest of the countries, the rest of the world, sees this as a Fed is all together, and we are not political or not divisive by the political maneuvers of, a new appointments, etc. What FOMC press statement, again, this is not a surprise. At least this Fed has been very, very particular about communicating what they're gonna do ahead of doing it, so that market are not surprised. Downside risk to employment have risen. We've seen the labor market graphs, etc. So no surprises over there. And that's why they decided to do a 25 basis point rate cut, right? It's a proactive approach. In case economy weakens and employees and the companies start to lay off more employees. Right now, I think the companies are not hiring. but there are not mass layoffs going on. So they did at 25 basis points with this reasoning. Right? But this particular FOMC meeting was also a lot of Fed governance has very differences in terms of about the future, right? I think the right word is to use, as Mr. Powell said, is a divergent opinion. There is no differences among the Fed governors. We just have a divergent opinions. So if you look at it, FOMC meeting, they do their dot plots. The best technology that we can put our hand around is just put a dot on where you expect the the rate should be in 2025, 2026, 2027. The bigger the box, more divergent the opinions are, right? So we had FOMC like say up to 4.5% to almost a little less than 3%. Very wide opinion among FOMC members. Again, I think there was Stephen Miran. He was, and most of the governors were of opinion that we're gonna get 2 rate cuts. So we already had 1. We're probably gonna get 1 more. I think market is pricing in 2 more. Maybe I have a short there. Yeah. So market is pricing in 2 more. One is in October and another one is in December, right? And I think Stephen Miran advocated for 5 rate cuts. So I don't know. So maybe we'll get 1, maybe we'll get 2. I think market is currently pricing in 2 rate cuts. So it means we will eventually finish this year at 350 to 375 basis points. Right? But does that mean your mortgage interest is gonna come down? That's a different ball game. In fact, after the last year rate cut, mortgage rates went higher. Even after this FOMC meeting, we saw that 10-year yield also pushed up higher. So whether your auto loans, your mortgage loans, or any other loans will come down or not, because those are long-term loans. Fed doesn't control that. Fed only controls a very short-term overnight lending rate. So whether the long-term rates will come down or not, that is dependent on lot many other factors of what the market feels about the stability of Fed, the independence of Fed, how they feel about the US government. Because at the end of the day, if you're buying 10-year US treasuries, you're putting money on faith of US government. And if that faith is shaken out, you will demand higher interest rate to give money to US government, right? So that Fed can't control. But will be interesting to see where the mortgage rates end up into. Do they always follow each other? No, but they do rhyme together. But there are cases like we happened last year wherein the Fed cut the rate, but the 10-year went up, and mortgage generally follows 10-year note 10-year note rates. So let me go through some questions. The Tesla board is small Elon's brother's board. Yeah, Tesla board is filled with the Elon's cronies. So right, so that's not an independent board. I don't care what anyone else has to say, but it's all friends and families kind of a stuff. So you have to be, if you're an investor in Tesla, make sure you understand all these and still go ahead. If you want to invest, go ahead and invest. I am an investor in Tesla, but at least I'm not fooling myself into assuming that, yeah, everything hunky-dory, this is the most shareholder-friendly company. No. The stock has risen and is given great returns to shareholders, even if, that doesn't mean it's a shareholder-friendly company. Mike is saying, if I, as an investor, can retain more return in stock market by myself, it is better for firm to return the treasury cash to me via stock buyback, so I can earn more on it. Yeah. Yield control is coming next year when the Fed chair is appointed. Yes, we could see more cuts around next year once the composition of the Fed changes. On the equities, we gotta get a new all-time highs. SPY all-time high, QQQ all-time high, Dow Jones all-time high. There are individual stocks that are like through the roof. right? I came across this chart, and if you know of anyone who's like wondering in the start of their investing journey and wondering, should I invest, not invest, especially younger investors, kids fresh out of college, or maybe, been in job for like 10 years and wondering, should I invest or not? Show them this chart. This is over the last 50 years. Again, when we talk about investing, it is always long term. Right? So there's nothing called short term investing. Or I would say the long term investing is a superfluous phrase. When you say investing, it is actually just long term. Inflation up 6x, T-bills 8x, S&P 500 almost 290 times. Right? You have to own businesses if you want to protect or increase your purchasing power, right? And you can own the businesses. Maybe you run your own business. If you have a capital and capability and enthusiasm to run your own business, great. Or you can buy businesses. If you are a big multi-millionaire, billionaire, you can buy the businesses as a whole, as a private equity, or buy the businesses completely. You don't have a multi-million or billion to invest in, you can buy small portions in the business to stock market, right? That's why I love the stock market, because it allows me to buy many businesses. If I buy one business, let's say laundromat, a lot of capital get allocated and fixed only in one business. Too much risk. I would rather buy multiple businesses through the stock market. And the only way to beat inflation is to own the businesses, because businesses will increase the sell price. They're not gonna take a hit on their profits. And if I own the business, I automatically get benefited with that.
Vivek, you brought up a good point on H-1B visas, new graduates. I mean, for the $100,000 fee to get the best that aren't already in the U.S., that is good. But what about the new graduates? Like I met in April, are any employer going to pay $100,000 for them to work here? I don't think so. They just graduated.
So I don't. Again, I saw some tweets and some of my friends have shared. I think there are a lot of immigration lawyers have put down various use cases in which the companies will have to pay 100,000 or may not pay 100,000. I think overall understanding is, if you are in US and your petition is being filed while you are in US, then the companies don't have to pay $100,000. But if you're outside the US and then your petition is being filed, then the companies have to pay $100,000. That's a summary I got. I could be wrong. I mean, I'm not there's a lot of tweets coming across and messages on some of the different WhatsApp group of my friends. A lot of my friends will get impacted through this. So there's a lot of stuff going around. Again, I'm sure this will get challenged in quotes, right? Small cap index also hit up a new all-time high after 4 years, right? So this is IWM, which is Russell 2000, new all-time high after 4 years, because of course, if the loans become cheaper, the smaller companies, get much better breathing room with the cheaper loans. Another interesting chart I came across was some hidden risk in the banks, right? Unrealized gains or losses on investment securities. Shouldn't be a surprise, because we have seen that was one of reason why some of the banks failed in 2023, but we are not out of the woods yet. Right? So if you are interested in banks, and cutting down the rates will have a tailwind for financial industry, right? Because the banks will generally borrow at a smaller duration rate, which is going to come down, and they lend it at a longer duration rates, right? So any reduction in the Fed rates is good for financial services industries, but make sure that your bank can hold these bonds or T-bills till maturity, right? Otherwise, the balance sheet goes upside down. David, these are losses in bond holding. Yeah, this could be unrealized losses, right? But you have to, I mean, if there are securities which are marked as available for sale, then you have to mark to market on your balance sheet. Right. Other equity news, Nvidia gets put $5 billion. I think there was an earlier question on Intel, so let's not talk about Intel. 4% stake. Nvidia takes 4% stake in Intel. That brings total outside investment 16 billion, which Intel really needs cash, a lot of cash, because if they have to execute on the vision of becoming a competitor they are already a competitor for TSMC, but not really a competitor, right? If TSMC has got 90% market share of all the advanced chips, then you are really not a competitor, right? So they have to build all this capacity and capability for competing against TSMC, and they'll need a lot of cash. So this does give a cash to Intel. From an Nvidia perspective, I wasn't really sure. I mean, yeah, of course, they could justify it by saying we want to build, chips, custom chips for GPU kind of workloads, and I think they also mentioned that they will, the chips that Intel will be for both for the data center as well as personal computing. On the personal computing, they will integrate Nvidia chiplets and all that. To me, it also get a little, give a little political score for Nvidia, because now Intel is also a little bit of a government-owned company, right? So Nvidia is also buying and being on the right side of the government, right? But there is no mention of Intel's manufacturing business, right? Is Nvidia gonna source their chips, GPUs from Intel foundry or not? Maybe they'll continue to source it from TSMC, right? And then $5 billion is what? Like 0.1% or 0.01% of overall Nvidia market cap. It's nothing. So I think it's more important from narrative perspective. It's more important for Intel than anyone else. So sometimes I think maybe, Jensen did this deal to score some brownie points with the administration, because saving Intel and making sure Intel can survive this and create more jobs is where the administrations, they've been touting this for months. So, but if you're an Intel shareholder, wow, what a ride! The stock was up almost 28-30%. It was like from 22, 23 to all the way to $32. So I did sell a covered call when it was around $31 or something. I sold a covered call at 39, which I think now already hit the profit target, probably will get closed. Maybe I'll hold it. I don't think it's expiring on 17th October. I don't think it's going to go till 39 on 17th October. This was too much a jump on something that we have yet to see, a meaningful growth in the business. So just a capital moving. All right, what else we want to talk about? Let's skip this one. Let's talk about US and UK major nuclear power deal. There was a question around Oklo, right? Why did Oklo go higher? Because of this. So there is a multi-billion-pound deal that US and UK had signed, that they will build 12 nuclear reactors in England that will power the data centers. And guess what? A lot of these nuclear companies, stocks ripped higher. Oklo was up like 28%. This is when I took the screenshot on Friday. which like these are the uranium, SMR 20%, Rtae 3%. Damn. Right. So all these uranium-based companies, uranium ETF, or companies which basically process uranium, I think Cameco, CCJ is that. These stocks have done great over the last 3 years. Ever since we started to look at AI and anything that is related to power generations, especially nuclear, have done pretty well. So that's the reason. There was a question earlier around Oklo. So this is where we have. Fine. Another stock, the one that I talked about earlier, I think during the earnings review, got upgrade from RBC Capital. Finally, Wall Street is starting to pay attention to this stock from $6.50 to $15. So I think stock was up another this week, another 10-15%. YTD, this stock is up to 110%. I think it is still lot of room to run from a long-term perspective. Short-term, I don't know. I don't care. Companies in turnaround phase. In every quarter, I'll come and give you an update on what I like or don't like about it. Over the last 2 years, ever since the new CEO came, I think I start to like this company. So we're gonna hold it. What else on the equity side? TikTok deal got we have a framework for the deal. I don't think we have reached the deal. I think latest news today morning was we're going to have a 6 out of 7 board members of US TikTok will be US will have a say on the 6 board members. ByteDance will own 20%. The rest will be owned by a consortium of private equity, Andreessen Horowitz, Oracle, etc. So that's happened. Google and PayPal signed a multi-year partnership around agentic commerce. So one thing good on PayPal that I've seen is they moved from being a payments company to a commerce company. Very specific. I mean, I see the CEO being very proactively and diligent about conveying the message that PayPal is an e-commerce commerce company and not just a payments company. And this is, I think, again, one more step in the direction of signing a deal with a Google, because 2 years later, agentic commerce will be commonplace, right? We'll have AI agents buying and selling on our behalf. And I think Google is trying to become a leader in defining the foundation layer of the protocols, etc. that they will use. I think Google has come up with AP2, agentic payment 2 protocol layer, and now they're forging relationships with a lot of these companies that have built payment infrastructure. So this is not exclusive. I think Google has also formed similar relationship with Union Pay. I don't know whether they have it with WeChat also. But there are a bunch of companies with which Google is forming these partnerships. So if you're a PayPal or a Google shareholder, something to keep an eye on. And then, of course, we had a Meta Connect 2025. And we had a Zuck keynote. And the stuff that happens in live demo actually happened there. It didn't work when they were trying to demo the new Ray-Ban glasses with the Neuro band. It failed. And I think they blamed it on Wi-Fi. But later on that, I think somewhere on Twitter I saw, or X, I saw that the person in charge of operating system for that demo, which was in demo, that got fired because it didn't work. New Ray-Ban glasses demo didn't work. But I mean, it's something to watch out for, because Mark is saying the Ray-Ban glasses sales trajectory is similar to the most popular consumer electronics of all time, which we know it's been an iPhone. Not saying that he's claiming that they're gonna sell them billions of Ray-Ban glasses, not at the price, maybe now it's at what, $700 and $800 price point, but it could become the next computing, the paradigm for next computing platform, which is what he's been trying to do, because he lost the the race to Apple, it lost the mobile race to Apple and Google. It doesn't want to lose the next race. So as per Mark Zuckerberg, phones will be replaced by smart glasses of how we access internet and go about our day. And that's where he's focused on winning that part whenever that becomes a reality. So that's all. I think a lot of stocks I'm seeing on the chat. So let's see what else you guys found on other stocks. Jose say most of my position got end of last year and they're all finally paying out. I recently got into BB. If you're looking forward trades, look at interest rate, home builders, financials, etc. Yeah, but home builders didn't do well at least this week. But I'm a little more bullish on the financials because two things, right? Because one is the earnings multiples haven't changed on financials just yet, right? So number one, the EPS growth will be better. And number two will be the multiples also defined over the stock price. So the multiples haven't really changed much. So which should get repriced. So I'm bullish on financials as well. So I basically sell puts on XLF and we get assigned, I'll buy it. What else? I have bought anything else? Mike has another long message. H1B issue, opportunity short, Accenture, Cognizant, Infosys, Wipro. I don't play the shorting game. If you really want to short it, maybe sell a call spread, buy a put spread. But I'm not going to go and short the stock. You never know in terms of what can happen in a short term, right? So this is the first level impact that we are seeing is with an H1B issue, these companies will get impacted and all that. So I don't know what the second order effects would be, right? So I generally don't short individual stocks. Neeraj asked, which stock you're referring to going from 210% YTDs? That's for the Jumia Technologies. I mean, I've owned this stock for 5 years, almost 6 years now. I just put a ticker JMIA and been watching it performance since then. If I had seen all seasons of craziness and then coming back down to earth, up to like $2.50, now back to $12 or it's around $11 or something.
Hey Vivek, question. Have you been putting on any small cap trades?
Not specifically looking into small cap. I mean, if I'll do small cap, I'll do IWM. Some of the individual companies that I hold have become smaller because some of the stock got hammered, so I'll still hold them. But otherwise, I'll just do IWM.
Okay.
Selling a put on IWM.
Because I know small caps and IWM's running, but IWM's not going to have as much, alpha as one of these individual companies.
Yeah, the issue with the individual members are you need to understand the business and follow the company.
The riskier, obviously.
Yeah, I don't have a bandwidth to add one more company to my list. And small cap generally will be a lot more volatile and will need a lot more close monitoring. And that's why I would stick with ETF.
Yeah, makes sense.
Ravi, which energy stock are you recommending for future? I am not doing individual energy stocks because I don't understand this, the business drivers and, what makes one business different from others. At the end of the day, energy is a commodity, right? And also it gets, so net, I don't understand. Like I say, right? Not sure why one business should score over others or what are the KPIs, etc. I should monitor. So my energy investment is through ETF. So I'm not recommending any energy stocks. I don't think I hold any energy stock, individual energy stock in portfolio. Alina is talking about Nebius. So Nebius is the Yandex in new avatar. Once Yandex, after the Russia invaded Ukraine, a lot of, I was bullish around Yandex, which was the Googles of Russia, the biggest search engine in Russia. But then after the whole sanctions, etc., the team that formed Yandex, they moved to Europe. And that's why they started Nebius. That's why Nebius is Europe-based. I don't know. Is it in Netherlands or somewhere? Somewhere in European country.
It's in Netherlands, but they're building out like data centers. I mean,
So
Nvidia has invested heavily in them. Microsoft now has a deal.
So it's the same playbook as we see other like core. These are folks called neo clouds. Not hyperscalers have run out of capacity, so they are trying to buy capacity of Nvidia chips from wherever they can find. And obviously, Nvidia will invest in that, and these companies will turn around and buy back Nvidia chips. So there's a lot of capital. I don't want to use the term round tripping because I think that's got negative connotation. But some flavor of that I see going around is like Nvidia investing $10 billion. I don't know what the amount is, right? But let's say Nvidia investing $5 billion in Nebius, and Nebius turn around and buy $5 billion of a chip from Nvidia, show it as a revenue, right? So it's just the same money that's gone around. I'm sure the legal teams on the Nvidia and the Nebius have covered all the bases, but I'm seeing this happening in many other companies, right? I think they did with the similar with the CoreWeave also. But all these companies are seeing the demand from because they have demand for AI chips, and they have access to these Nvidia chips. Right. So same business model, CoreWeave. I don't know what's the differentiation between the CoreWeave and Nebius would be, right? Unless exactly at a system level or the rack configuration level how one is better than other. It's the same. Basically, it's the same at a little higher level. It's the same stuff. You basically get Nvidia chips, create your racks or data centers that will have Nvidia GPUs, and then rent out the data centers to whoever they want to. And in many of these cases, Nvidia itself is renting out the space from these people because Nvidia is also building its own cloud service. So it's like Nvidia giving money to a company that buys Nvidia chips and create a cloud service which Nvidia rent the cloud service from. So yeah, I'm not on any one of these just yet. I mean, I'm happy owning Nvidia and a lot of other companies for my AI play, but these tickers are very come on, Thinkorswim is dead. These tickers are very popular among a lot of retail investors. And influencer, it generates a lot of discussions. Nebius, CoreWeave, and the stocks have been ripping higher. Wow, it was like $20 in April, now sitting at $100.
Yeah, that stock is rising. I bought it early, and I'm just like, wait, why is this portfolio going? It's an interesting stock. I don't know how much more room to grow, but it's definitely a growth stock.
It's an interesting stock for sure. But like I said, I would rather I'm owning Nvidia. I've not looked at it. Maybe we want to also look at it. How much of business is is it just Nvidia, or they're also diversifying and hosting, let's say ASICs, etc., that Broadcom is building? Because all these have the same business model, no differentiation. They are all riding the AI wave that we are seeing. Sridhar, Melly did not follow the market high. Any reason? Why should Melly follow what's happening in the US market? Melly business is all in Latin America. So I am not surprised that it did not. I mean, I would be surprised the stocks just run up because of no reason. If the dollar weakens, yes, then I would see a lot of these companies which are outside of US, those stocks will go little higher, because if the dollar weakens, then your dollar denominated reporting will be bumped up. But other than that, Melee has no business in US. They're all businesses in Latin America. And that's why I like owning it. It gives me a little more diversification outside US. Rajiv is a Bitmain founder having a day with their GPUs. BMNR. Come on, it's now a Ethereum treasury company. You're still talking about it as a computing service providers to the mining companies, to the crypto mining companies. Come on, Tom Lee hasn't told you enough about it. That's a Ethereum treasury company now.
No, I was referring to companies like Iron.
Okay, Iron.
Which, yeah.
Yeah. Iron is also like Lorberin News, similarly. Again, I have seen during the crypto mining boom of 2017 and I think 2020s, like a lot of these crypto miners were this Iron. I don't know. Is Iron a crypto miner, or is it's the miner that pivoted to now AI stuff? Integrated data business.
Yeah, they're all pivoting to HPC.
Yeah, they're all this. So like CoreWeave was a crypto miner, and they built up the build up the data centers because they wanted to mine crypto. Then suddenly realized, I have a computing capacity. Oh, we have a lot of need for this computing in doing AI. Okay, let's pivot to AI. Okay, so even the Iron also started as a Bitcoin miner. That's what it says here. And now it's providing their capacity to AI. So we'll have to see, right, how many of these miners will still be able to. So right now there is so much demand. Then anyone opening up a decent amount of data center is getting business, but it's not going to continue the same. Right? At some point of time, you will figure out that the business is going to saturate because there is not much of a differentiation or a moat that you have in this business. So you've got to be really careful if you are investing in these. Alan says then Nvidia might as well give them free GPUs still as an investment. Yeah, but, regulators will come behind it. You're making it very obvious. Yeah, Mike has got the right comment, right? NBS, Oracle. I think I'll still put Oracle on the main hyperscalers as number 4, but Nebius, CoreWeave, Iron, they are all serving the marginal capacity requirement. Right? Let's say the need for this computing start to come down. Google or Microsoft is first, they'll be the first one to drop the contracts with CoreWeave and the Nebius because they're not gonna drop the usage of Azure. They'll want to use as much of Azure, and only extras is all coming to these companies, right? Which will get dropped off once the demand slows down, or Azure is able to build its own capacity, right? So right now it's just the capacity constraint game. What do we know about the buzz of OpenAI investment in India? I don't know. I didn't follow that. What else? Electric energy stocks are not oil stocks. Oh, okay, energy stock. I think I heard about Eaton. Then there is a GE, Vernova. They are doing good. Oh, sorry. Let me make sure. GE Vernova is that aircraft. I got confused in terms of which is which one. Okay, so Vernova is electric. So that is in the power one, right? GEV that's in power one. So there are a lot of, when you're trying to invest on the AI, you can invest in at a different level of the whole stack, right? Starting at a chip level, you got Nvidias and AMDs of the world, right? Then you come into the rack level. You can invest in the companies that build those racks, like SMCIs of the world, right? Then you come to the data centers. You have these many companies that we talked about it. You'll have the companies that provide cooling solution to data centers. There are companies that provide electrical connections. You will need all those wiring, copper, everything. The moment you try to build a data center, so many things get into the data center, right? The question is, you want to buy the individual companies, you want to buy some of the ETFs that represent it. There are many ways to play this game. I would want to play in which I understand about the company a little bit, right? And and let others enjoy the on the other side. So you figure out where you are more comfortable with it. You want to play with the utility side because there's a power need. Nuclear is also being driven by all the AI. So this whole AI revolution has driven so many industries right now. You pick and choose your poison. And there is nothing right or wrong. It's just that if you understand it, it's the right thing to do, go ahead and do it. I will not do some of the things because I don't think I have an edge in understanding it or time or energy to spend on it. But there are a lot of these so-called old economy industries that build, let's say, electrical connectors, right? Electrical panels. You will need all those stuff whenever you're building these data centers. There are all stocks have run up high. Just that I don't understand the nuances of that business very closely. Is Lyft a good for long-term invest? What's your thesis? I don't know. I mean, I see Lyft and Uber as a competitors. Don't see any difference between these two businesses. And Uber is much bigger than Lyft. So I'm invested in Uber, so I don't want to take position in Lyft. But if you don't have any positions in ride-sharing business and you want to do with the Lyft, maybe right now probably is a better time because Waymo just signed a contract with Lyft. I think more important, it was as an investor for me, it was more interesting to me as an Uber investor because now Waymo is basically telling Uber, you're not the only game in town. I'm gonna negotiate hard with you when we're trying to roll it out the Waymo taxis on Uber app in the next city. It's a bargaining chip that Waymo has secured against Uber, and I think, but it also gave a good lift to the pun intended to the Lyft stock after this partnership was announced. See, the stock went up another 10-12%. Because Waymo announced a partnership with Lyft. I think they're starting with Nashville, if I recall it correctly. So you could basically hail Waymo through the Lyft app, which right now you can do on Uber. You can have Waymo come and drop it.
Vivek, Uber is kind of like a multi-product, multi-sector company. Where Lyft is still the operator only.
Correct.
So Waymo is investing in it. Waymo has the technology, not Lyft. Is that right?
Correct. So Waymo basically has your driverless AV technology, right? So you could, on the Waymo app, you can have yourself picked up by, on Lyft app, you could summon a Waymo. But again, when you talk about these businesses where there are network effects at a global level, maybe at some local level, Lyft has got a better penetration than Uber, right? But Uber is much bigger and a little more diversified business than Lyft is. So I like Uber, but can you take advantage of a swing trade in Lyft? Sure. Right. But not for me, but that doesn't mean it can't be for someone else who want to take a position in Lyft, because right now there are some positive tailwinds coming out of it. Lyft also, did they not buy a company in Europe? They're trying to expand outside US. But again, Lyft is fully focused on ride hailing. business only, whereas Uber has got multiple business streams. So that's why I'm an Uber. I've been in like Uber for a few years now, been selling premium and reducing my cost basis. I'm like at maybe $30 is my cost basis, so I'll hold Uber. Maybe if I want to diversify from like I own Coke and maybe now want to also get a Pepsi, yeah, then I'll buy Lyft. But right now I don't see any need for me to buy into Lyft. But if you don't have any position, yeah, maybe you could look into Lyft.
So I have Lyft positions. I also have like a Uber call option. Vivek is right. I think Uber is a global company where it's also diversified in sectors such as food delivery or other sorts of delivery. I think they're working on like drone delivery for certain food in certain areas. And Lyft is definitely like a smaller market. They're like the second tier player into ride sharing, mostly operating in like I would say North America, mostly US and Canada, and their market share is like a fraction of Uber's. I mean, their market cap is like a fraction. I believe Lyft is like 9 billion. And I forgot how much is Uber, but it's maybe like
Uber
you
is
know
140.
8 or 10 times bigger in terms of market cap. So I think Lyft has a tailwind in that, because it's a small cap company, and when interest rates lower, maybe in like the next 2 years, I think they're going to get that push for higher valuations for small cap companies. After that tailwind ride for like a couple years, it might stabilize, it might normalize. I don't know, but definitely Uber, it does have like a more stable and, because it's a large cap, I think both of them have rooms to grow and expand. Lyft is more like a, consumer interface. So of course, I don't think they have the autonomous driving technology. So, partnering with Waymo is definitely a smart move. It kind of gives them a push to tap into the autonomous driving space. So
I mean, we are looking at the similar discussions like Intel versus AMD during the Intel heydays, and now we're talking about Nvidia versus AMD, right? Yeah, there are some use cases in which AMD has done great, and at least in that you have some differentiation in terms of some of the workloads might be more suited, and you may not need as expensive as AMD GPUs, or you could run your workloads on AMD itself. But there is almost, when it comes to the ride hailing, again, as an end consumer, there is no loyalty, there is no differentiation. I will go to whichever riding service is the cheapest one. Now, if I have a Waymo on both, I'll compare and see, whether it's a Lyft is giving me a cheaper ride or whether Uber is giving me a cheaper ride. So the reason why I'm more on Uber is because at a very long term, I view ride hailing as a very commodity in which there is almost no differentiation. You are only competing on a price, and when you're competing on a price, scale is very important. Bigger the scale, you can get better economies, you make advantage of economies of scale. So that's why like Uber more than Lyft, because Lyft has got only ride hailing, which over the long term, I'm not too enthusiastic about any moat or pricing power in that stuff, unless you have a big scale. But Uber has got some other stuff as well, like their advertising is coming up. They are cash flow positive. They are actually returning cash to shareholders because it turned around this business, and they could move into other areas much quicker than Lyft. So that's the reason why I'm in Uber. But yeah, there are some tailwinds which we are seeing for Lyft, which could give them a boost to the price, as well as if they can take advantage of the boost in price, maybe raise more capital, etc., and can then venture into other businesses to insulate themselves from a pricing war, sure. Right. But because I already own one, I just don't want to own the second one, which has got a lot more to prove itself.
Vivek, sorry.
Yeah.
Go ahead, Jose.
No, so you're basically just saying Uber's a better buy and hold long term, because I think it's also right. The two sizes of the companies is going to determine your time horizon. You know what I mean? I got into Lyft because I knew it was beat down and cheap, and the numbers were turning positive. But I'm not going to hold it for the rest of my life. You know?
Yeah, I mean, you can always take a swing trade, but when I'm talking about the
exactly.
positions here, I'm like,
yeah.
Do you want to
you're
own
more
it
of
for
a
next
holder,
25 years, 30 years, right? Between Uber and Lyft, right now I'm more focused towards Uber for next 25 years.
Exactly. Yep.
You said you wrote options on Uber. What premium do you usually set it above the current market price? Do you set it 10% higher strike price or 20% higher?
So right now, let's say right now I have 80 and 105 strangle on Uber. Right. And I've been writing options on Uber for years. Right. So right now the one for October I have is 80 short put and 105 covered call on Uber. Yeah, so I'm looking at my my tracker. I've been selling premium since 2019. 2019 was the first time when I bought Uber at $44. And yeah, over the years, I think my average stock buy price is $43.50, and net cost is now $30.11. Because over last 6 years, I've sold $13.40 in premium per share. So it's got a good liquidity on the options market also. But right now I have, like I said, I have 80 short put and 105 covered call on Uber.
To follow up on the last person's question, do you have a rule of thumb for your calls? How far above the current price you'll sell your?
So it depends on. So let me answer that. I think I've answered it earlier. Also, it depends on what my outlook towards that business would be. For example, on Uber, I am doing this Uber stuff only to reduce my cost basis. I like the business. I don't want to sell the business, right? So I would do the short call at maybe 6. No, I don't look at a price percent higher. I look at the deltas. So I maybe do at a 16 delta, maximum 20 delta short call. Right? But let's say talk about other business, GM business, right? Which is, and I think I did bring this up when I was looking into Henry Bessenbinder study of last 120 years, that only 4% of the stocks make up for the most gains. And I'm looking at, I hold GM, I've held it for a few years. I'm like, is this the one which could become that 4% winner? No. It does give dividend, right? And so I was like, if it gets called away, I will not feel too bad about it. So on GM, I've been selling 30 delta covered calls. I don't want to sell 30 delta covered call on Uber because it's a 30% chance that it get called away, because I want to hold Uber for next 20 years. So it depends on the outlook of the business and, how much do I like it or how much do I hate it. And I have done in a case in a business in which I sold a at the money covered call because I wanted to sell the shares today, but why not wait for a few more weeks and get paid a little higher? Because I really did not want to get associated with that business for in the long term. So that's how I decide at what delta do I want to sell the option premium. Now in Uber case, I'll be happy to buy a little bit more if it goes down to, let's say, $80. And that is why I've played on the both sides when it comes to Uber. I have a 105 covered call, and I have a short put at 80. And I got paid $1.73 as a premium.
Would you ever consider, for any purpose, a delta lower than 10?
Lower than not, because you don't get paid enough to take the risk. Again, at the delta, it's just a probability, right? So when I'm selling 16 delta, is a probability tells me that 84% of the time it will expire worthless, right? But there are chances when, and this is called sequence of returns. So there are chances when it may not, right? So I want to at least get paid little bit for taking that risk. When you're going to 10 deltas, 5 deltas, most of the time those will expire worthless. But there will be some times when the stock will move so much that you will, unless it is a covered position, you will end up losing so much on an option trade that it will take away all what you've gained by over the past few months or years, very small one, and you lose everything in one. So I would prefer to get paid a little more for taking that risk. Going to 10 delta, 5 deltas is not, you're not getting paid enough to take that risk. That's thought. And I mean, there are some traders who have done 5 deltas strangles and have had a string of winners for a year, 2 years, and then few losses basically compensated for all them because they were not getting paid enough.
Have you found in your long term of selling covered calls that the capped profit and the foregone profit has been at any time higher than the premiums that you made?
So the way I look at when I do these covered calls, etc., is if I'm not gonna do it on, again, depend from stock to stock. But let's say I've changed my thesis and say I'm not gonna do it on all the holdings of my Uber, right? If I'm doing one contract, it is because I own more than 100 shares of Uber. So I'm looking at, even if this continues to go high, my rest of the portfolio will also continue to go high. Now, to answer your question, and in some case, I will just do a call spread. Right? Now, to answer your question on whether you looked at that, if you're not done that call, sold a call and just held the shares, would the portfolio have been in a better position? I think if you just talk about it theoretically, maybe, or maybe because I do play on the both sides, then not okay. But if I only done the covered calls, then maybe holding the shares would have been worked better for the last 3 years because the market is only in one direction. But the question is, would you have been able to hold it? Right? In theory, it looks great, but let's say you end up into a situation like 2022, wherein the stocks are down, you probably end up selling the stock, right? So in a bull market that we have seen in the last 2 years, in a rise in which the market is unidirectional, selling calls is not a winning strategy. You would have done better if you just bought and hold. Right? But I'm not looking only for 1 or 2 years. I've been doing it for now almost completing 9 years. I've gone through different cycles, and I play on both sides of the market. So for me, trying to generate an extra, a topping on top of my the portfolio cake using options has worked out really well for me. It has kept me in the market, not scared me out of the market, and basically build wealth. So last 2 years won't be great if you just sell calls, but overall, because the markets, they are cyclical, including 2022, made a lot of money in selling calls, right? It has worked out well for me.
So it's more like a psychological kind of hedge to help you hold. But that's the thing, like if you hold it for a very, very long time and you only see it for that long time, you need to be able to stomach downturns like 2022. Otherwise, you wouldn't be a long-term holder.
Yeah.
So I don't see why the premiums help you do that.
Right. Okay. The other thing is right now, I don't have any other way to generate cash flow. Right. But this is what my full-time work is. Now, I can't take my portfolio printout to grocery store and say, okay, you can give me pay my bills. I still need a cash to run the expenses, and generating some option premium does help in generating cash. Right. So that's a situation over last, I would say, 2.5 years. Right. Prior to that, I did have a job, and of course, that was my source of income. But even in that case, if I look at overall, whether the option trading has helped me or not, in 80% of the stocks, I've been able to reduce my cost basis, and that makes me much bigger long-term investor.
Have you been able to backtest it and compare the two strategies throughout your holding term and see which one would give you higher?
No, I'm not backtested it because I know as an individual investor myself, I would have got scared out of the market. The reason I did not enter into the market was I did not know what I'm going to do if the market goes down. It's only my investing journey is very different. It's only that I started getting big into the market once I realized I can either give myself room for error or I can fight back against the market using options to hedge the portfolio and be long-term investor. I actually became much longer-term investor after I started doing options. So for me, options is helping me to become a better buy and hold. So I'm not saying that it's for anyone else. It all depends on your makeup and how comfortable you feel. Let's say you have other sources of income and you don't care what happens to your portfolio in the next 10 years. Yeah, just buy and hold. I am trying to find a ways that will enable me to buy and hold my stocks for much longer term. And I've found that options help me in doing that.
It's more like a personal reason rather than a return-based or performance-based reason.
Oh, yeah. So I'll be okay to sacrifice some of the return in a short term if it helps me in a long-term return. And let's say in 2023, right? And I've told many times here, when the market is ripping higher, I'm happy to lose money, a little bit money on my option trades because my hedges will lose money. And hedges losing money is a good thing because it means the portfolio is going higher. Theoretically, in theory, I could have argued with myself, why the heck I put these hedges? But imagine April, the Trump tax, the tariff we came in. If I haven't had those hedges, I can imagine myself sweating in and out and wondering how am I going to pay the bills that are coming due. I would have to sell some stuff. Investing is always very personal. I hate when people say, oh, this is the only way you get made. No, this is my way of making it. And I'm want to be very clear. This is my way. You have to figure out what works for you as an individual.
Vivek, one question. Your portfolio consists of stocks that you bought directly as opposed to had them assigned to you after selling puts. Do you know what I'm saying? Have you gotten into the market basically through selling puts and being assigned, or by directly buying the stocks?
So I've done both. So for example, when I started building position in a Rtae network, because that's I think one of my latest one. Latest means 2023 or 24. So first I bought, and again, I want something as to dip my toe so that it's on my radar. It shows up on my brokerage platform. Then I need to go and study this, right? So when I do my dip my toe position, I'll just buy the stock outright, right? I'll buy 10, 15, 20, some percentage, like 0.25% of portfolio, maybe 0.1% of a portfolio so that it's on my radar. Now, as I become more comfortable, I'll build a position. Let's say if I have a 50 shares or 100 shares, then I say, you know what, I think I'm comfortable with it. I want to play big, then I'll start selling strangles. Or once I understand the company and business, then I'll start selling puts. The question is not either or. So for me, it's a mix. I've done both. Right? My first purchase would probably always be, let's buy 10 shares, let's buy 15, let's buy 50 shares so that it shows up on my radar. I don't forget about the stock later on, and then continue to build my thesis on it. Once I build my thesis on it, I'm like, yeah, I think I can buy 100 shares comfortably. Then I'll go and sell a $30 delta put. So it's both. It's not either or. And sometimes I'll come and tell you, right, that this week I bought, like last week I told you I bought Mercado Libre 2 shares. Because, was it last week or week before that? Because the current prime minister's party lost and the stock was down 5%, which I was like, what? Doesn't make sense. I just bought 2 additional shares of Mercado Libre. But I also have Iron Condor sitting on Mercado Libre in case if it falls further down, I'll probably buy a little more. So it's a combo.
Vivek, a question. I mean, your session is very informative. But are you, in your way of doing a stock, are you targeting certain amount of income per year? That's a kind of a goal that you have when you are balancing your stock portfolio?
Yes. Now, specifically over the last 2-3 years, I have to. Earlier, I was not focused on it because I had a W2 income. But now I am focused on, say, I need to, and now I'm looking forward, and probably I'll tell you reason, right? This week, buy or sell, I took an assignment on a covered call because I'm looking at, for next year, I want to build enough cash so that we are having like 3 great years of this market. I'm starting looking at it in 2026. If this market is gonna maybe return negative, I want to build up my cash position enough to survive for next year. So I might be willing to take some covered call assignments right now because I have to pay bills for the next year. For this year, I'm already covered, right? So yes, now I have to make sure that I can withdraw enough cash from my portfolio to basically pay bills. So
I guess you've addressed it before, but if you are reliant on the market and your portfolio to some extent for your living expenses, your aversion to dividends is kind of curious to me.
Yeah, so again, because from a dividend perspective, I can generate my own stream of income, right? After doing for so many years, I know that I can generate 5 to 10% of my portfolio by selling premium on the holdings that I hold, right? So I don't want dividend which are unnecessarily country-based taxes, but I know I can generate that much of a cash flow. So that's why I don't want or don't like to depend on dividend income. I hope that answers the question. I mean, that's because dividend income is not tax friendly, and I have other ways to generate cash.
Yeah, thank you.
Of course, if you don't have any other ways to generate cash, then you'll invest in these income ETFs, like all these yield max stuff, which I hate. I don't like that. Or you invest in like annuities and all that stuff will give you consistent income. I have ways to generate consistent income, and hence I'm like, maybe I can do it myself rather than either buying into some of these yield generation. Okay. All right, let me go through some comments. Sorry, was there any other question?
So, just tax friendliness. And options income is tax friendlier than dividend income. Is that what you're implying?
No, but in a dividend, you get taxed on both 2 sides. Guys, if you own a stock, you are a business owner of the company. Because I get shocked when people say, it's only one tax. Why are you saying double taxation in dividend? Because I pay only once I receive a dividend, right? And I'm like, no, You already paid a tax when you offered the dividend. You are an owner of the business. So as an owner of a business, of the company, my company has to pay taxes when they give a dividend to the shareholders. Then I receive a dividend as a shareholder. Then I have to also pay taxes on that.
Yeah.
So if you think through the owner of the business mentality, assume that you run your own private business. You're 100% owner of that business. Why would you ever pay dividend to yourself? Because the moment you, let's say you run an I can't say XYZ, ABC Incorporation, you are the only shareholder, 100% owner, and you pay dividend, then you're as a corporate side, when you're filing your corporate income tax, you will pay taxes to the government on the dividend that you paid. Then once the dividends flows through you, through your 1099, and then you declare that as a dividend, then as an individual income tax, you again pay a dividend. So it's a double taxation. But you have to think as an owner of a business. So that's what I'm saying. As an owner of Meta, I'm a very, very small percent owner of a Meta, but I am owner of Meta. I don't want Meta to pay double taxes.
I have a question on when you're writing options on your holdings to generate income. Are you just doing it regularly, or like what's the period and like?
Well, I have a regularly options always open,
So
and
you're just
you
doing it
can
all
see
the
it on
time,
my
every week.
Not all of them are every week. So let's say I'm already building my October portfolio, right? So closing down the September, building October. There are some tickers which I will do every week. Like then the ticker need to be liquid enough and the bid-ask need to be tight enough that I can do it on a weekly basis. There are a few which I do. One is, of course, all my hedging trades are weekly. I have a trade that is expiring next week and the week after, then 3 weeks from now, like QQQ, SPY, etc. Then a lot of these are Bitcoin ETFs and Ethereum ETFs, IBIT and ETHA. I'll have weekly trades. I mean, let's say right now I'm putting the trade, I'll be putting for 17 October expiration. But because I already have it for the 3rd October and for the 10th October. Right? But yeah, mostly I will be doing at a monthly, the regular monthly cycle. But then there are a few takers, either the hedging trade or there are a few selective takers in which I will do, I'll have a weekly options active on it.
Okay, got it.
Oh, by the way, I mean, you can see these ones on the website, right? It gets published over there. So you can see what's the expiration level, etc. And it's all available for free. You can see it. All right, let me go to some other questions. I think Mike already answered. How many week expiration do you sell your covered call? I try to do it 3-4 weeks. So right now, October, probably it's a last week. Maybe next week is the last week that I will do any more new October trades. And then I will then start building towards the November portfolio. Buy and forget is the way to go. Oh yeah, but unfortunately, most people can't do buy and forget. And I'm one of them, right? I can't just buy and forget. So I have to figure out the ways to make me buy and hold. For me, which is buy, hedge, and hold. Some people can skip hedge completely. They can just become buy and hold. I am not that person. I am a buy, hedge, and hold. DeFi and dividend or sell stocks over time necessary options are a way to generate bunch of taxable events. It is taxable, but if it's generating cash for me, I'll be okay to pay those taxes. One could take on HELOC and use it. I would rather do HELOC is more expensive. I would rather do a box spread to basically take loan against my stock position, and you can get a loan as last time I did it, I got it at what 4.6%, right? Okay. All right. Too many questions. I'll skip that. So if there is anything that is urgent, I want me to address, just why don't you? unmute yourself and ask. Otherwise, I'll move forward with the rest of our discussion.
Before you move to another point, I wanted to go back to the income point. There is another idea, which is to take a loan against your positions, and if it's a small portion of your position, shouldn't cause a big risk, and that would entail just an interest rate rather than a tax rate. Wouldn't that be more efficient in having income to sustain yourself rather than selling options or going any other route or dividends?
So, and what rate do you pay? And number two is, do you get blocked from doing trades on your positions, etc.? Third is your if I take that loan, what happens when my portfolio goes down, like it went in April? Do I run the risk of selling my shares? My shares getting called away because they liquidated?
Yeah, that depends on the ratios, right? So how much is the proportion of it? But if you have like a credit line, say per se, and you spend, if you have a portfolio of $600,000 and you spend like $60,000 per year and on a credit line, and that's almost 10% at risk of your position. So is that something that
I'm open to it.
Fun?
Yeah, I'm not saying that's thought away. I'm open to it. I look at it and see, what restrictions it put me and what's amount of a risk or a level you can get it. I'm open to it. I mean, I'm looking for, in fact, I called up Charles Schwab saying, why don't you enroll me into those, if you have short shares, you can lend your shares to Charles Schwab, you can get paid interest. They told me I'm already enrolled, just that there were no instances in which they could take my shares and basically give to the short sellers. So I'm open for it. The question is figure out what works for you and then stick to it. There is no one right way to do it. Over the years, I figured out this works well for me. It interests me. And because I love reading about companies, and then I feel good about it when I say, hey, I invested $1,000. I've already taken out $1,000 from that investment. I still hold all the shares. Then I can become much better long-term investor. All right. Looking at the fear and greed index, the index is moved a little bit into greed. So I want to be a little cautious. And sector-wise performance, we're looking at almost 12% return year over year. So we need 8% more to get to 3 consecutive 20-year percent gains, which will be only the second time in 75-year history. 8% more, guys, 8% more we are looking for. Buys and sells this week, just got ICSH parking some cash here. Sells, Doximity, I took an assignment on the covered call. Again, the stock is trading. This is trading on a very high valuation. Not that I hate the company, but I don't think the business growth over past few years that I've seen in the company justify it. Just that all stocks are going higher. With any name in AI, this stock also is higher, and it hit my covered call. I thought maybe I should defend it or not, but then I'm looking at it. I need to start raising cash for my next year, and this is one hell of a overvalued stock. So let it be called away. It's okay. It's okay. I will not have a seller remorse if it continues to go higher. It's not that I found it that it's undervalued and then let it go. I think it's already overvalued. The other stock we already talked about, Jumia had a covered call. So I sold the call, basically sold the shares and closed the call. I had a trading position when the stock was at like $2 something. I added more because I thought market had just punished it for no reason. So it got called away at 6. I'm perfectly okay with it. I have another lot that might get called away in maybe next week if I don't defend it. probably are not. I'll have to see. Was it next week or when do I have that? Then I'll sell a little more of it. Yes, I have a $11 covered call September 26th. If it get called away, I'll let it get called away. So, but I still hold this in my portfolio. I'm looking at an opportunities to now start building a little bit more cash to start thinking about next year. I'm kind of already done for this year. So I don't want to take any more stupid decisions or any more risky investments, etc. If I had W2 income, the life could have been a little different, right? But this is just me based on how my life has been set. Okay, looking at the crypto market, today morning we are at 4.15 trillion. Overall, not much of a difference between the last week. So nothing much to discuss on individual ones unless you have specific questions on this is what got a top 10 here. Any of the top 10 crypto. Otherwise, let me jump into a few of the crypto news that I saw. SEC greenlights the generic listing standards, this is much bigger news than what the market has talked about it. It means they're gonna get a fast approval. This is already happens in the regular equity ETF market. So eventually, the whole crypto asset is gonna look very similar to how the other, let's say, equity asset class looks like. So SEC greenlighted the generic listing so that every ETF doesn't have to go through the SEC route. Exchange can say, yeah, we're gonna list it. It's already fall into our framework, which SEC has approved it, and now they have. And immediately after that, we start seeing all kinds of crypto ETF coming into the market. Now we have a Dogecoin ETF, ticker DOJE, right? So be ready for any and every kind of ETFs in the crypto side, right? Also, we saw SEC approved first multi-asset ETF. So basically from Grayscale, they have digital large cap fund. They converted into ETF, which is gonna, we already have an individual ETF that invest in one particular crypto. We have a Bitcoin ETF, we have Ether ETF, we have Solana ETF. I think it recently got approved. But now we got a multi-asset from Grayscale, 70% Bitcoin, 17% to Ether, and then XRP, Solana, Cardano, and all that stuff. So, I mean, guys, we're gonna get a lot more of these things. Again, this is a supermarket. You got a junk food, you got a healthy food. You as a shopper have to figure out which one you want to pick. It's not SEC's job to tell you that you should invest in XYZ. It's your job to know what you're investing in. And
Vivek, do you know the story about Ethereum? I mean, like, what's the value?
And I've been tracking Ethereum for 7-8 years. And I've talked many times about what's the value prop of Ethereum.
Oh, okay.
Right. So, right, that's basically call it a digital oil, call it basically the smart contract platform, disintermediation, and latest is becoming maybe as a safe haven asset. I don't subscribe to that, but there are many who do. So there are many use cases of Ethereum. The only idea is which one will get adopted. And we are very new in this game. It's gonna be another 20 years. So you have a lot of time. You have a lot of time to explore this. Right. So another interesting chart looks like this is Bitcoin starting from 2013. If we have a green September, then October and November are also green. Again, the history doesn't repeat itself, but sometimes it is interesting to see. Sometimes it rhymes, right? Selling may go away, stuff like that. So we're trying to people are trying to figure out similar patterns, seasonal patterns on the Bitcoin also. So right now, Bitcoin is sitting at 116K. The idea is if it's going to close September positive, I'm already seeing some estimates coming up. Oh, end of year 140, 150. Who knows where it's going to end up? No one knows, but everyone can take their guesses. So that's on the crypto side. Now the last topic is around why investing is simple but so difficult. It's not easy. It is simple, but it's not easy, even if you know about the markets. So let's dig into that. Let me sip some water, and then I want to cover a study that was conducted by Alternative Assets. Alpha Architect, gosh. I knew there was a double A's. There's an Alpha Architect that did a study by data from 2017, 2016. I found it really interesting. I thought I'd bring it up for discussion in this meeting. Give me a moment. Let me sip some water. Like David says, tokenization of all assets, right? RWA, real world asset tokenization. Digital payment report, payment rails. Just Google for, let's say, and you can look for I think Fidelity recently did a report on Ethereum, which I came and reviewed in this meeting. Just go through it. I mean, they've covered a lot more use cases. There's a Bitwise report on Ethereum. A lot of these institutional funds have done the homework for us. We just need to go and read about it. Any thoughts on SEC chair considering ending quarterly earnings report? I had a topic, I skipped it. I thought no one is interested in it. But since you asked, I think I'm okay with it. Oh, I really don't care. So I think some point of a time, because they are, if you look at in Europe, it's already 6 months, right? But then majority of the companies still report on a quarterly basis. So in a way, I think could be better, because what I don't want my managers to do is to give me quarterly guidance, because I think that basically pushes them to think short term, because now they're given a guidance. They have to meet the guidance for next 3 months. I don't care what happens in next 3 months. I want you to focus on what's going to happen in next 2 years, 5 years. And if that means to build that capacity or to spend right now, which will bring your earnings down for next 2 quarters, go ahead, do it. So if the SEC says that it's okay, you can report the results every 6 months, I'll be fine with it, because it means at least like they will give a guidance, not for 3 months, at least little more longer term guidance, which is fine. And maybe the companies will continue to give the data at 3 months. The negative side of this is, let me just finish my thought. The opposite side of this is, as a retail investor, I will not get to know what's happening in the company for now 6 months, right? Because I don't have that information coming out. However, if you are a hedge fund guy, if you are institutional investors, you may have more ways to get access to the business information about the company. And I'm not talking any nefarious ways that you have insider information. Let's say you may employ people who will go and see how many cars, how packed is the parking lot of a particular store is. That will give you some insight into how the company is going to do in month over month or 3 months. I only get to know how the business, the revenue did, or how many customers came in once I see the report in 6 months later. But you as a hedge fund, or as an institutional, you may have other ways to get the information. So from that perspective, yeah, it's a little bad that I don't get to see after 3 months. But me personally, will be okay if I don't get to know what's happening in my company for 6 months. But I don't think majority of the retail investors will be okay. They want to have information on like every weekly basis because people are just want to trade on that information. I don't want to trade on that information, so it doesn't matter to me. But one good thing which it will do for me as an investor is that it will at least get the manager focus away from giving these quarterly guidances, which sometimes I feel are very short-sighted.
So is what you're saying that this getting rid of quarterly reporting would basically require 6 months reporting, but companies would generally have a tendency to provide quarterly reporting without giving the meeting guidance.
Yeah,
but they'll still
that'll be
provide
best
the
of both
reports.
worlds. That'll be best.
But they'll still can or try to provide the reports without giving guidance.
Correct. And I'm wondering if I'm a CEO and I've already set up, my machinery is already set up for giving you 3 monthly report. And I say, you know what, if I give you a 3 monthly report, maybe as an investor, I'll score some brownie points. So why not? I'll give you 3 monthly report, even though SEC is not mandating. And that's what's happening in Europe. It's not mandated that you'll have to give 3 monthly report, quarterly report. In Europe, it is half yearly. But a lot of companies still give quarterly reports in Europe. And we may see that the companies might still give quarterly reports because their internal machinery is all set up and may refrain from giving guidance at a quarterly basis, which I like. I want them not to give me guidance for the next 3 months, but think a little longer term. All right. But it will be not good for those who want to trade on or want to run some swing trades 3 months out, etc. Yeah, that won't be good because you won't have that information. But I guess people will then start trading on something else. They'll start trading on what the CEO said in a particular interview. Traders will trade. I think those who want to trade, they will trade. Maybe we'll trade on something else. Maybe we'll trade on what he said in a Goldman's tech conference. What products is the company display in CES? We'll find another ways to trade if you want to trade. All right. Last topic for today. Another spend like whatever 15-20 minutes, and then we'll go into the breakout rooms. Is investing with God's foresight. Right? It was a theoretical study conducted because no one has God foresight. Right? This is impossible to replicate in real world. So there's a financial advisor who has got a God foresight, and they already knows what stock will perform the best and the worst in next 5 years. Right? Because now we have a historical data, so we have the power of that hindsight. Now I'm assuming I'm sitting in 1927. I already know which stocks in 1932 will be the best performer over this 5-year period, and I also know which are the worst performer. Right? Now, having that insight in 1927, I'm investing in 1927, having that insight on what stocks will be the best performance in 1932. This is exactly what is called as a crystal ball. Right? Should be great, right? We all want to do it. Let's see that God is a financial advisor, and then she builds a client portfolio based on this foresight. Right? All of us would want to invest our money with that person, right? Come on, does anyone out here say that you don't want to invest money with God, financial advisor? You already know what's going to happen in 5 years. And the reason they took 5 years is that's a not too small, not too long a holding period. And, most of the investors have kind of this time frame. Driving, looking at the back window or a mirror. No, you're looking into future and you know what car is coming around the corner before the car came around the corner, right? You already know. So there was a study done, Alpha Architect. They basically computed 5-year look at return for all common stocks of 500 largest these firms. They eliminated all the companies that did not have full 60 months. And then they looked at the gross returns for all, including the dividends, and then created a portfolio based on forward 5-year CAGR. This is how the portfolio would have done. And then you rebalance the portfolio after every 5th year. Then you come up with the next. Now in 1932, you already know what the stock prices were 1937. You find out from 1932 to 1937, which are the best 5-year CAGR stocks, and you buy those stocks in 1932. This is how the God's portfolio would have done. It gave you almost 30% CAGR year over year. Right? In practical, it's not possible. If you start growing your portfolio 30% every year, you will be the richest person in the world. Right? From 1927 to 2016, you'll own all the stock exchanges kind of stuff. But it's an academic exercise. And the worst one was like 15%. Right? And this is where the average is like SPY average is 10%. So you would say, yeah, everyone should invest with the God's portfolio, 30% CAGR, that's great. Right? So here we investigate some of the stats, right? God's best, God's worst, and S&P 500. So God's best CAGR, as we looked at, is 30%. All of us want to have that. Worst drawdown is 75%. Remember, you're looking at a 5-year period. Even the best stocks go through the drawdowns. Apple has gone through 50% drawdowns at least 4 times. Nvidia very recently, last year was it earlier this year, had a 50% drawdowns. So the best portfolio also had a drawdown of 76%. The worst one, like almost wiped off. Like it was down almost 100% at some point of a time, and then recovered to close at negative 15.32. S&P had 85% drawdown. So then they plotted S&P drawdown versus from the max. So even the God's best portfolio had huge drawdowns. The bigger question is, would even God may not have been able to survive these drawdowns of 40% in like 5-6 years if you haven't built your enough cash position. So in theory, it looks great, 30% CAGR, but it doesn't come with these drawdowns. So the trick is, how do you survive these drawdowns? That's an interesting one. And then they looked into the, how much time did it take to move from one peak to other peak when you had those drawdowns, right? So you had a drawdown from 2008 to 2010, took you almost 2 years. If you had hired her as a financial advisor, you would have just fired her after 2 years, saying, I didn't make any money in 2 years. Right? Or in this case, almost 3 years. So interesting. Even God, I mean, I think the heading of this study was, even God would be fired as a financial advisor. Even with this perfect foresight, it's very difficult. So they told, why not try other things? What if the God becomes a hedge fund manager? Then you do both long and short. Okay. So they go long on God's best and short on God's worst, and you rebalance it monthly. So because I already know which stocks are going to perform worse in the next 5 years. I already know what stocks are going to perform the best in 5 years. So today I'm going long on the best one and shorting the worst one. That's the best of the both worlds. Even that has a worst drawdowns of almost 48%. Better than just going long. But again, this is just academic exercise. You are not God, I am not God. I don't even know what's going to happen to the stocks like say 2 weeks later. Forget about 5 years later. Even with the 5 years later, you had to go through a drawdowns of 50% multiple times. Now this one, long short hedge fund. You still can't escape 40% drawdowns. Multiple opportunities where you lost 20% over time. It is not riskless. Would this God have a maximum asset under management? Because when he, as a financial, this doesn't apply to us because We're not managing. I'm not sure about you, but I'm not managing money for others, so I'm not competing against others. But most of the fund managers, let's say we're investing with a fund, they all compete against other fund managers, right? And you're only as good as the next, as good as how have you performed in this quarter against the average market. Like it or not, market, the investing community thinks of the average market as what's S&P 500, right? How have you performed against S&P 500 is what generally we think about. And that's what people ask questions is, do your portfolio do better or worse than S&P 500? Now with God's insight, God's foresight, long shot, God hedge fund, there have been occasions when you have underperformed S&P 500. Okay? So even with this perfect insight into what's going to happen in future, if you build your portfolio, still there are multiple occasions in which, as a client, you would have fired God saying, come on, I can make that money in S&P 500. Why am I paying you fee for managing my money if you can't even beat S&P 500? That was an interesting study that I found. I'm like, wow. That's why investing is simple. You just buy, some good companies or S&P 500. But if you are managing money for others, so difficult. But or even for yourself, if you're comparing yourself for S&P 500, even with the perfect foresight, the God would have gotten fired by their clients, right? So I found it really fascinating. And here we are trying to figure out what stock can I do it 1 year, 2 year, and trying to change our portfolio, turn it around and figure, maybe we can find some alpha in this and all that stuff. Whereas if you knew about it, you still can't avoid drawdowns. So for me, the lesson from here is forget about how great company you found or how in-depth study you must have done. Find a way in which you can survive the drawdowns. We always look at how much money can I make? Can this company become 2x, 3x? We rarely think about the drawdown management. And I think over the years, what I think has worked for me and the stories that I've heard from some of my friends is managing the drawdown became much more important because it helps you to stay in the market for much longer. So for that, if you have to sacrifice a % of a return any year, I think it's a good deal. If you can manage your drawdowns that you don't have to sell your shares or figure out whichever way that you can just survive through the market anyway has a positive tailwind. You don't have to find the hottest stock of this year. You don't have to find the best performing stock, etc. You will still do okay as long as you can just stay and manage the drawdowns. Some people can do it in their sleep, and I don't care. Good for them. If you're not one of that kind of a person, find out another ways how you can stay in the market. Options has helped me. That's why I use that as a vehicle. There may be other things that help you. Go ahead and use it. Drawdowns will come. Even God has to face 75% drawdown or 50% drawdown. Rajiv, so Renaissance was beating God for 3 decades? No, Renaissance probably would have had their own drawdowns, but I think Renaissance had like 30%. It was like equivalent to God. That's the only one which at least I'm aware of, the H1 which have consistently used a quant to generate alpha in the market. I don't think anyone else has been able to do it. But you can't do it with a huge sum off. And number 2, there will be drawdowns. That's why Renaissance they don't manage any outside money. But even with this CAGR, which Renaissance has been able to generate, they would have gotten fired because they would have had their own drawdowns. They only manage the money of their own employees or the group that they are. They don't manage outside money. Because you know, if I'm managing my own money, you know, no one can fire me, right? I won't fire myself. So I'm sure NSM would have its own drawdown, even with a godlike return. All right, so that was the last topic for today. In terms of the content that I wanted to share and talk with you guys. Now we can open up the breakout rooms for any other discussion that we want to have. I will stay on the lobby for some time to answer any other questions that you may have. Then probably we'll jump into the breakout rooms.